pleasure of being here to share with you some of my views on this timely topic based on some of my recent research about the transformation of the state sector. I'm going to show you in minutes why these two things are kind of closely related. A quick remark is think about the primary goal. One of the primary goals of the state presence in the banking sector in China, this goal is trying to maintain the presence of state-owned prices in the Chinese economy. So that's why the transformation of the state sector, what's happening to state-owned prices in the state sector in China is very much relevant to the future evolution of the financial markets in China. Let me just bring us to China kind of 15 years ago. Take a look at how the picture looked like in China. In the end of the 1990s, if you take a snapshot in the manufacturing sector in China, you will find that most state-owned enterprises were actually about to die. More than half of the state-owned enterprises making losses. The total losses they made account for about 10% of the total industrial output, which is a really big number. And because of the dying manufacturing sector, you see a rapid accumulation non-performing loan ratio in the banking sector. Some of the major commercial banks in China at that time had a non-performing loan ratio as high as 40%. So that's why some experts arguing, the Chinese economy at that time was about to collapse soon. But just a decade later, if you ask the same question, how the state sector looks like, and then probably you will get the entirely different answer. You will see this is a sector full of powerful industrial giants. They've been growing very fast. They're making huge profits. And in this presentation, I'm going to exactly lay out the framework why this big transformation is relevant for future reforms, potential reforms in the financial market. And our discussion will be based on our research, which is designed to try to understand what are the basic driving forces for this big transformation. And in China, this policy, what we call grasp large and let it go small, is kind of well known, but it's kind of less well known outside China. And we think that's the key to understand the transformation of the state sector in China. The second part of the policy, as you can see from the name, is kind of easy to understand. Let it go small just means let's shut down and privatize those small, medium-sized state-owned prices. That's nothing surprising. This is kind of one of the most popular ways of dealing with those problematic state-owned prices around the world. It's nothing unique to China. But the first part of the policy needs a bit more explanation. So what does it mean, grasp large? We view, grasp large is basically a process of corporatizing all the remaining big state-owned prices. Basically, you can view state-owned prices, most state-owned prices 15, 20 years ago can be viewed as kind of an extended arm of government. They've been doing a lot of things, but very few things are related to profit maximization. But after corporatization, you see a kind of separation of government and state-owned prices. And as a matter of fact, many remaining state-owned enterprises now have been putting more and more emphasis on profit maximization. So along that dimension, you can see nowadays corporatized state-owned enterprises are quite similar to those private firms or privatized state-owned enterprises. I will come back to this issue in a few slides. But first of all, let me quickly go through what's happening to the state sector through let it go to small. Before jumping to the picture, let me just quickly remark, what are the exit rates for state-owned prices and private firms 20 years ago? If you look at the annualized exit rate for private firms 20 years ago in China, you will find that the exit rate is actually quite comparable to the typical number that we see in many countries, which is around 12% or 13%. But the exit rate for state-owned prices 20 years ago is essentially equal to 0. It means even if you're creating huge losses, there's just impossible for this kind of ailing state-owned prices to exit because you just receive a lot of government subsidies and supports, explicit or implicitly. But here, this is a picture about the exit rate for state-owned prices, which is the red line, and the exit rate for private firms, which is the blue line, we basically group firms into percentiles according to their initial size. So strikingly, you can see during this period of time, the exit rate, the annualized exit rate of state-owned prices is actually above the exit rate of private firms. And in particular, if you look at those firms with initial size below the median level, you will find that the red line is clearly above the blue line, indicating that there are actually some extra forces encouraging small and medium-sized state-owned prices to exit. So that's entirely consistent with the policy of let go the small. And another striking thing is, let's take a look at the rate of privatization, that is, how many state-owned prices have been privatized. So once again, we put these state-owned prices into percentiles according to their initial size. And then you can see on average about 40% to 50% state-owned prices. So these are the firms that used to be state-owned in 1998. And later, these firms get privatized. But another interesting thing is you can see for those biggest firms, for those firms sitting in top percentiles, the rate of privatization is actually very low. If you look at the biggest firm sitting in the top percentile, the privatization rate is just below 5%, it's just around 2 or 3%. So that exactly consistent with the second part of the policy, that is graft large. So these firms are the firms that the central government or state government really want to maintain. Of course, the next question is what has been happening to the efficiency of the remaining big state-owned enterprises. One thing to check this is to estimate productivity. So in economics, is what we call a total factor of productivity. So this is a measure teasing out price effect, teasing out many other things. So that can be viewed as the best estimate of productivity. So for the time being, let's just focus on the top three panels from left to right. In the left top panel, we have two lines. So once again, we group firms into percentiles according to their initial size. And this red line is the level of TFP for state-owned prices in 1998. And this blue line is the level of productivity for private firms 15 years ago. So you can see this just huge gap between these two lines, indicating that private firms are way more efficient than state-owned prices 15 years ago. Now let's move on to the middle panel. That is exactly the same picture, just 10 years later. And you will find that the gap appears to be a lot smaller. Okay. And then the most striking thing is if we further move on to calculate this annualized TFP growth for each of the firms. And then you will find that for firms with initial size below the median level, then there's essentially no big difference in terms of TFP growth between private and state-owned enterprises. But for these initially very big firms, especially if you look at these firms in the top percentiles, so this is quite important for the total industrial output. These firms sitting in the top percentile, by the way, account for about 60% of the total industrial output in China. And then you will find that these biggest state players enjoy very high TFP growth. So these guys managed to grow its TFP, its productivity, at an annual rate of close to 10%, which is about 7 or 8 percentage points higher than their private counterparts. So this is a really big difference. To be sure, we are not arguing that nowadays state-owned prices are more productive than private firms. We're just saying that now the overall situation has been improving, and now you see a convergence of productivity between state and private firms. And as I will mention later, this is going to have some implications on the future reforms of financial markets in China. Productivity is just one aspect through which we can understand the transformation, but there are many other ways, through which government can influence the transformation. For instance, we know that in China, there's just huge distortions in factor markets. 20 years ago, the government has been, 20 years ago, government imposed a lot of kind of labor rigidity, preventing state-owned enterprises from firing workers. So if you got a job in state-owned enterprise 20 years ago, it's kind of what we call the iron rice bowl. It means that you sort of got a lifetime job security there. One interesting question is whether or not this situation has been changing over time or not. So one estimate that we have is if we try to estimate how costly this kind of labor rigidity for state-owned enterprises, we can take a look at this bottom left panel. The red line tells us the estimated costs coming from this labor rigidity as a share of total labor compensation in these state-owned enterprises. And 15 years ago, you can see that cost appeared to be quite high. It accounts for about 30%. So this labor rigidity accounts for about 30% of labor compensation in the state sector. But over time, you see this line has been falling dramatically. So in 2007, this ratio is just somewhere between 5% or 3%. It becomes entirely negligible. A sharp contrast is, let's take a look at capital market distortions. Echoing the presentation, the talk just given by Fabrizio, we understand that state-owned enterprises receive a lot of preferential policies from the government. The state government is just trying to provide cheap credit for those state-owned enterprises or those enterprises that have been well connected to the government. So if we calculate the actual capital cost faced by private firms and compare that with the actual capital cost faced by state-owned enterprises, you will find that the actual capital cost faced by private firms is about 100% higher than that for state-owned enterprises. Moreover, this blue line tells us the gap appears to be quite persistent. There's no big change to capital distortions. So how do we interpret this 100% difference in terms of actual capital costs? If we think about the annual capital cost of state-owned enterprises consists of two components. One is a 10% capital depreciation rate, and the other is 5% lending rate. And then it just tells us the actual capital cost faced by private firms can be as high as 30%. If we take away a 10% capital depreciation rate, then this calculation suggests that the de facto lending rate faced by private firms can be as high as 20%, which is 4 times as high as the official lending rate for state-owned enterprises. So this just gives you a sense of the magnitude of capital market distortions. Of course, this is also going to be crucial for us to understand the future reforms in the financial market in China. So here's just a quick summary. We found that the productivity of the remaining state-owned enterprises have been growing a lot faster than productivity of private firms. And the second thing is we find that the labor distortions, to a large extent, has already disappeared. However, capital distortions just remain quite stable through the sample period. Then the second part of the presentation, we're going to try to talk about the implications of this transformation on financial markets. First of all, here is a picture, a very simple picture about how the government has been trying to maintain a very distorted capital market, or try to maintain capital distortions more precisely. You can see we can come up many policy regulations designed to do that, but just to list 2 probably most important policies. The first one is we see the government has been putting an upper bound on deposit rate. Okay? And this upper bound appears to be binding. Okay? And the purpose of doing that is together with the policy setting a kind of floor on lending rate and make sure that these commercial banks, and most of these commercial banks are state-owned, will have a kind of big profit margin. And another purpose is once you set a ceiling on deposit rate, then you can get money from households, firms at a quite low rate, so that it allows you to provide cheap credit to state-owned enterprises or those connected enterprises. So this is kind of one pillar of the financial system. And another important pillar is this partially closed capital account. That is, in periods when the domestic interest rate is below the world interest rate, in periods when Chinese households, Chinese firms want to invest their money abroad, then actually by this closed capital account, they cannot do that. So that also helps banks to kind of the government to channel money from households, from firms to those units to which they want money go. So these are kind of two important pillars of the current system. Okay. And just give us a little more details. There are three lines, three different kinds of interest rates. For the time being, let's just focus on the red line and the blue line. So we all know this. This red line is the lending rate, the benchmark official lending rate, and the blue line is the official deposit rate. You can see a big profit margin. The difference between these two lines on average is about 3 percentage points. And the third line, the green line here, is the US T-bill rate. And you can see, actually, in some periods, this T-bill rate is obviously above the deposit rate. So what does it mean? In these periods, if China has an open capital account, then it's likely that Chinese households and firms probably want to invest abroad, invest the money, save the money in T-bill rather than just save money in bank accounts in the domestic market. So from this picture, you can see this is how, you know, closed capital account contributes to this integrated financial market in order to just channel money from households to state-owned enterprises. And on the demand side, I just mentioned that there are a lot of distortions, or a lot of preferential policies designed to lend cheap credit, offering cheap credit to state-owned enterprises. And you can also see from this graph, there are two lines. One, bottom red line is capital returns, average capital returns at the firm level for state-owned enterprises. And not surprisingly, you can see this, this capital return has been rising in the state sector thanks to, you know, the improvement of productivity in the state sector thanks to the diminishing labor distortions. You can see things have been improving. 15 years ago, the capital return in the state sector in China is just essentially equal to 0, but now it's kind of fluctuate a bit between 10% and 15%. But if you look at the other blue line, that is the capital returns at the firm level for private firms in the private sector. And you will see over time, this line has been also growing actually at a faster rate than the red line. So what does it mean? It means this is exactly a reflection of very distorted capital markets. And these firms really need capital. They're very much constrained by capital. So that's why they have extraordinarily high capital returns. In particular, recently, you can see the rate of return to capital in the private sector could be as high as 40%, 2 or 3 times as high as that in the state sector. So everything just suggests that we really need financial reforms. And here is another picture just telling us kind of a big picture about how the financial sector nowadays looks like in China. This top blue line is the total bank loans as a ratio of GDP. Sorry, bank deposits as a ratio of GDP, and the bottom line is the total bank loans as a ratio of GDP. And you can see this blue line has been rising over time. But you have a kind of relatively stable red line. So what kind of messages we can learn from these two lines? First of all, as Fabrizio just mentioned, the difference between much of the difference between these two lines will eventually translate it into T-bills, foreign government bonds, with very low returns. And if you look at how these bank loans are allocated in China, you will find that most of these bank loans are just flowing to state-owned enterprises, flowing to those less productive units. So here you can clearly see how distorted, how inefficient China's financial market is. Because the difference between these lines has been invested into low return assets, and this part below the red line much of it has been allocated to less productive state-owned enterprises. So the overall picture looks quite bad, actually. So that's why we really need financial reforms. And what kind of reforms that we may expect? One thing is certainly marketization of interest rate. And currently, both deposit rate and lending rate are heavily regulated. So one way to do that is just to let market forces determine interest rate, in particular the deposit rate. Another possibility is just to liberalize capital accounts. Well, let's think about what are the potential consequences of doing these two different reforms. From the recent experience based on the rising shadow banking sector in China, based on this growing kind of wealth management products, we see if we try to push marketization of interest rate a little bit, then the domestic deposit rate will be increasing for sure. So along this dimension, it seems that we have already reached some consensus that after marketization, then you're going to see a higher interest rate. But what will be the consequence of capital account liberalization? So let's take a look at this picture. So once again, there's three lines. The red line is the Shibor rate. So by the way, China has a kind of dual track interest rate system. The interbank money market, the interest rate in the interbank money market is kind of endogenous, determined by market forces. The blue line is the one-year deposit rate, which is basically set by the central bank. And this green line is the LIBOR rate, which can be viewed as world interest rate. And the interesting thing here is it seems that if we try to liberalize capital account at this point, then probably you're going to see an inflow of capital from the international financial market. So in that sense, the domestic interest rate probably will go down rather than go up. So overall speaking, these two different types of financial reforms may have quite different implications on the new equilibrium interest rate. Despite of this difference, I would say these two different policies may have quite similar effect on the macroeconomy of China. So for instance, if you take a look at interest rate marketization, 1 percentage point increase in the deposit rate, of course, is going to imply big redistribution from the banking sector to firms and households. That's one thing. But more importantly, I think this marketization will encourage banks, especially these state-owned commercial banks, to look for high-return projects. They probably will move a little bit away from state-owned enterprises and invest in projects with high returns. So overall, this is going to improve capital allocative efficiency. And opening up capital account to a large extent has quite similar implications. The direct effect, of course, as Fabrizio just mentioned, huge amount of foreign reserves now sitting in low return assets may probably be further diversified. Chinese individuals and firms may have better chances to invest in money, to assets with high returns. And more importantly, this is actually going to provide pressure on state-owned banks to divert their resources away from state-owned enterprises. So in that sense, marketization, interest rate marketization may have quite similar effects as current capital account liberalization. So another thing that is kind of more dramatic financial market reforms, that is how about let's just lift up all the preferential policies designed to help state-owned enterprises or low productive but well-connected firms. We can do a kind of simple calculation. What are the overall benefits of this capital reallocation? So according to our estimate, if somehow Chinese banks can reallocate capital towards more productive units, then we estimate that the overall size of the Chinese economy probably will be increased by about 30%. This is a big number. You know, think about currently a lot of discussions have been suggesting that Chinese growth has been running out of steam. But you know, if this kind of reform can be done in the next 1 decade, so what does it mean? It means approximately every year it will contribute to the annual growth of China by 2 or 3 percentage points. This is a really big number. It's just because the current status suggests that China has really distorted financial market. If we're able to somehow improve the performance of the financial market, there will be a huge contribution to the future growth of China. Once again, having said all these benefits, let's go back and think twice about what are the political, economic barriers for China to reform this distorted financial market. If you think about the objective function of the Chinese government, you will clearly see they're facing a trade-off between efficiency and the relative size of the state sector. Because if they really want to maximize the size of the economy, if they really want to maximize the efficiency of the economy, the best thing they should do is just to cut all capital distortions all the way down to 0. But then what does it mean? It means on the one hand, you can increase a lot the size of the economy, but on the other hand, you're going to hurt the state sector dramatically. Probably the state sector will disappear entirely. So once again, as I mentioned at the beginning, one of the primary goals of having this state-dominated financial market is just trying to provide supports for state-owned enterprises and those well-connected firms. That's one of the primary goals of having the current financial system. Having said that, I want to make a point that is, thanks to the rapid productivity growth in the state sector, thanks to the improving labor market efficiency, if this kind of financial reforms are kind of totally inconceivable 20 years ago, 15 years ago, now the transformation of the state sector makes this kind of reforms more likely to happen. So one example is just take a look at this non-performing loan ratio in Chinese banks. 15 years ago, you can see the red line is the non-performing loan ratio in China. That ratio is around 25% to 30%. This is really high. At that time, it's just impossible for Chinese government to reform this financial market because that means probably all major commercial banks is going to die and all major state-owned enterprises are going to die as well. But now, as you can see, this red line, for a variety of reasons, this red line has been falling dramatically. Nowadays, it's been even lower than non-performing loan ratio in OECD countries, which is plotted in this bottom blue line. One important reason, of course, is this big improvement in the state sector. So that's why I would say, you know, over time, you will see the political economic barriers for financial reforms have been diminishing. Here's my last slide. in the end, let's draw attention back to this capital account liberalization. I would say marketization of interest rate. Of course, these two things, marketization of interest rate and capital account liberalization, are two closely related stuff. But I would say capital account liberalization is probably politically less controversial than marketization of interest rate for a very simple reason. If you want to marketize interest rate immediately, then of course we all know without liberalizing capital account, then what would be the consequence? As I mentioned earlier, domestic interest rate will be shooting up, right? Just think about what's happening to the shadow banking sector in China. What's the consequence of this growing wealth management products on the interest rate in China? And what does it mean? It means, you basically take resources away from these state-owned commercial banks. So that's why they're probably not so happy to see this process. However, capital account liberalization, if you think through the minds of the policy makers, if you think through the minds of those big state-owned banks, the consequences, the implications of capital account liberalization is more subtle. So that's why I don't think, politically, I think capital account liberalization might be easier to be implemented than marketization of a complete marketization of interest rate. Another thing I want to mention here is that timing is also quite important. Currently, because of this big gap between domestic interest rate and the world interest rate, I think it will be quite difficult for the government to liberalize capital account immediately. So the timing will be much better if you see a much narrowed interest rate gap between domestic market and the foreign and the overseas markets. And the last thing I want to say is, in the long run, I would say capital account liberalization will provide a very important impetus for Chinese government to move ahead with financial market reforms. Because once the world interest rate is probably above the domestic interest rate, then it will push state-owned banks, it will push commercial banks in China to look for high return products because they no longer can stay with this low cost of getting money from households and firms. That's all I have. Thanks a lot.
Thank you, Michael. I think we're running a little bit over, but we do have maybe about 5 or 10 minutes that I think we can save for some Q&A. So if I can ask Fabrizio and Michael to both step up to the stage. And please, if you do have any questions, just let us know and somebody will bring you a microphone. So first of all, just thanks both of you for these excellent presentations. I feel much more educated for having listened to them, and I have to say it brought me back to university days, although I can't say I did terribly well in these sorts of classes. I would like to go back to this last question that you were discussing, Michael, which is the difference between opening up the capital account and marketization of interest rates, because as you yourself noted, they're very closely tied together. But you said that it's easier politically to move on capital account liberalization. The question I have for you is, can you really move on capital account liberalization without marketizing the interest rates? Because as you noted, for instance, you had a period of time where T-bills were returning more money than was available in China if you were a depositor. Right now, obviously, there's not a very good return to be had on your T-bills, so you wouldn't have to worry about people rushing out to buy more U.S. Treasuries. But that's not going to stay the case forever. So are these things really separable?
Right, so theoretically, I think if you kind of write on a model, of course the model going to tell you should first marketize interest rate. You should let market forces decide interest rate, and then you can literally have liberalization of capital accounts. Theoretically speaking, that's true. But let's think about, if you think through the policy decision-making process in China, I can imagine if we have capital account liberalization first, in a period when domestic interest rate is above, when the domestic interest rate is almost equal or slightly above the world interest rate, then this is the period sort of everyone would like to welcome capital account liberalization. There will be no problem for state-owned banks to say no to that, because they would like to see capital inflow. It means that they now have more resources to manipulate. But think about if we move on to a period in which domestic interest rate is below the world interest rate. By the way, when we say domestic interest rate is below the world interest rate, we say that the interest rate is still controlled by the state government. We don't have marketization of interest rate. Then what will happen? Clearly, as Peter said, people may just choose to invest money abroad, may just purchase T-bill. And what will happen next is you will see naturally there will be market forces pushing these state-owned prices, state-owned banks to go ahead with this reform. So theoretically speaking, it's true that we should have marketization of interest rate ahead of capital account liberalization. But in the particular situation of the Chinese economy, I would say in terms of this political economic consideration, a positive theory would predict that we probably would see capital account liberalization ahead of marketization, because I just want to emphasize that capital account liberalization going to provide the political foundation, would provide these incentives for these banks to go ahead.
So I would like to add something. I guess the answer to your question depends on what position we take on the exchange rate. So if we have a fixed exchange rate, then we cannot do it. Otherwise, we generate arbitrage opportunities, which would be taken. But if the exchange rate is floating, then the exchange rate adjustment can take care of differences between the U.S. interest rate and the renminbi. In principle, you can appreciate and depreciate and generate a path of future appreciation or depreciation that compensate for the difference. I mean, I would say that something else. I mean, I guess one of these. So the exchange rate is one of the key issues here. So what I would like to know and understand is in this capital account liberalization idea, does it go together with rethinking the exchange rate policy, or does it imply that the central bank will continue to target some exchange rate? This is important because we know from other experiences that the combination of fixed exchange rates and capital account liberalization is potentially risky. So there can be tension on the currency, so the credibility of the peg can come under attack, and more generally, the monetary authority loses control on the monetary policy, because if the monetary policy is used to control the exchange rate, which could be like they are doing now in Switzerland. So we say, well, the monetary authority is willing to purchase all the excess of supply and demand of currency in order to keep the exchange rate constant. Well, that makes the amount of money in circulation endogenous. And that means that there is imagine, for instance, that there is a big pressure for appreciation, but the central bank fixes the exchange rate and purchases a lot of foreign currency. Well, that's going to increase the monetary base and potentially generate inflation. So in general, one of the dilemmas. So it would be somehow interesting just to go beyond the notion of capital account liberalization and understand what type of policy regime then will be taken. Because clearly this is one of the potential issue. And I mean, until a short time ago, many people would think that the big risk was a strong appreciation of the renminbi. But now my impression is that you know, at least if one looks at on the short run, there is no more such pressure. Yeah. The other thing I wanted to add, it takes me a bit astray perhaps, but it's not clear to me a priori in the moment in which the capital account is liberalized, what type of movement of the exchange rate this per se would generate. Because clearly we would have an increase of the gross flows, we would have capital coming from abroad, but also demand for taking position abroad from Chinese residents. And it could be that the current situation in which the impression is that there is not a great pressure on the renminbi may be favorable, because certainly one doesn't want to do is doesn't want to see huge fluctuation in the moment in which the policy is implemented.
Thank you. Any questions from our audience? Yep. Over there.
Perhaps a bit of a general question, but how crucial or relevant at this juncture do you think the economic growth rates in the US and Europe are with regard to the pace at which China is able to improve the convertibility of its currency?
Well, I think there are two forces here. One is, you know, the more stable the world macroeconomic environment is, the better it is for this project to go ashore without big turbulences. So the current situation in the European bond markets per se is not something good, because it can create a lot of speculative movement in one or another direction. Counter to this, I would say in a longer time perspective, I would say that for some time, at least Europeans have been thinking that euro could become the second reserve currency. It has not taken up at the speed that we were expecting, but we were on that agenda. And somehow I feel that the recent events have put that very much on the side. And you know, the last point of my presentation was, you know, we need somehow to make sure that the provision of liquidity continue to be there, and somehow it requires, from the world perspective more than from the Chinese perspective, that emerging economies take up more of a role. Partly because of the growing sense of weakness that support that, because you know, we don't know somehow for sure if the euro as we know it now will exist in 5 years. It could be that all of this somehow calms down, but at the same time, I think that from this perspective, it makes the role of the convertible renminbi more urgent, if anything.
Yeah, I want to add some of my comments. That is, over the past few years, the pressure is there probably too much of capital inflow to China. Although recently we see the opposite pattern over the past few months. That's exactly because of this interest rate gap I just presented here. So if United States, if US economy, European economy continue to stay in kind of at the bottom, we will expect to see this interest rate gap will just continue. And then I don't think, you know, that will be a kind of good timing for China to fully convert its RMB, because they just worried about too much capital inflow. However, if we see US economy, actually US economy has been recovering. So in the near future, probably the gap will be narrowing. So that will, I think, will contribute to the whole process.
Thank you. Sounds like it's a pretty tricky business trying to figure out exactly the right timing, you know, both calculating what's going on in the world economy and then, you know, when the institutions in China are in place to make the move internally. Any more questions?
I found your data on the returns to private firms in China very interesting, and quite a contrast to the data on the profits of listed companies in China, which obviously appear to be much lower and not rising in the way your total returns are. Do you have any thoughts on why that divergence exists, and also if the current sort of relatively deregulated equity markets are allocating capital poorly, whether that suggests that the benefits of financial market liberalization may be less than estimated?
I don't have time to go through, the details of the data, but just let you know this data is based on annual survey of industries, and this survey is conducted by National Bureau of Statistics of China. So this is kind of sample much bigger than the pool of publicly listed firms. It includes all state-owned enterprises and private firms with annual sales above 5 million yuan. That used to be a big number, but now this is small potato. It covers almost all non-state firms. So that's why you see a kind of very big difference between profitability of these firms in the sample and these publicly listed firms. The data reliability is always a big issue in China. And when you go to these firms, you're going to say that we have 5 different accounting books. It really depends on what kind of books they show to those statistical officers. But I would say, of course, you can see different forces, leading them to over-report or under-report their profits. But to the best of my knowledge, so far we don't find any kind of systematic bias towards these data. So that's the first question. The second question is about the deregulation. True. So I think of course the important part that has been missing in my presentation is the stock market. Today we have more than kind of 2,000 publicly listed firms, and I feel comfortable to say that most of these firms are state-owned enterprises, or those firms connected, those well-connected firms. And consistent with our research, these firms tend to less productive than the average, although our research has been suggesting that the performance of many of these firms have been improving over time. But as a matter of fact, it's still way below the average of those non-state firms. So it's true that if we have further deregulation, then you will see quite similar, effect in terms of capital allocative efficiency improvement.
Thank you. Glenn?
Hello. I don't know whether I just rejoined the session, so I hope this is a question that the audience has not asked yet. Obviously, a lot of people has focused on timing and when the liberalization of the renminbi may take place. But if I were to ask you really 2 questions, the first is what impact do you see the liberalization of renminbi will have on the structure of the Chinese economy? And the second part of the same question is what impact do you think will have on Hong Kong?
So I take the first. Yes. So in terms of the, I guess you mean the structure of the real economy of China. So one robust fact that has been documented across several countries is that the pattern of specialization across industries reflect closely the extent to which different industries rely on external financing. So this was a paper study done by Rajan and Thingales, who is a colleague of Michael, and they find that in the moment in which you have some type of financial development episode or capital account liberalization, you should expect that industries that are more intensive in external financing would grow. What industries? Well, the typical case is pharmaceutical. So pharmaceutical industries and, in general, industries that rely more heavily on R&D and for a variety of reasons on a more, a higher sophistication of financial products would tend to grow. So I would say this is potentially an important element for China. China has already been, changing the industrial structure between the 1990s and 2000 in a much more high-tech direction. But even in the more advanced industry, it remains characterized largely by a lot of assembling activities. And I think that one of the potential benefits of the capital account liberalization, of a richer supply of financial products, would be the acceleration of this product. And clearly, it's a well-documented fact that this is a necessary step for growth to continue, because China faces, on the textile production, will soon face stronger and stronger competition from other countries. The wages are low, and then it has to somehow escalate the ladder if it wants to make all the transition. So I'm very grateful for this question, because I think it's a very important aspect of this debate.
Okay, for the second question, I don't want to pretend to be an expert on the Hong Kong economy, although I spent 2 years staying in this city. But just share, with you my view on that, based on my reading of a recent working paper written by some true experts in Hong Kong Monetary Authority. Based on the data talking about what's happening to QDII. So what they found is something very interesting. They found that these qualified domestic investors, once allowed to invest in overseas market, they try to first test water in US market, in European market. And once they got something like a setback, they would like to run immediately back to Hong Kong. So their research suggests there's a huge home bias. So I would say if you have a current account liberalization, in the short run, there will be a big boom in the Hong Kong market, I would say, because most of the investors who are not so much familiar with US, European markets, they were just flooding to Hong Kong. So that's my best guess about what will happen.
And after that? No, because I guess the risk is that other financial center will emerge and create competition also.
We don't know much about the long run.
I think this is a good question that you might want to recycle when our next speaker, Casey Chang, comes out. Anyway, thank you. We are running late. I want to make sure we have time for a break. So, oh, sorry. One more question here.
In fact, thank you for your insights. I guess right now, a lot of investors are quite concerned about, in fact, the PBOC, everyone's expecting them to do some kind of deregulation of interest rates. Apparently, that's happening now. But one thing that I think on everyone's mind now is the shadow banking part of it. Like, just be a little bit more specific in just the economic growth of China, but the shadow banking and credits, this deregulation of interest rates. What do you think the impact would be on this? Because clearly the stock market has been rout on it because of the situation here as well. So if you have any insight on that, that'll be helpful.
It's true that we see a very fast-growing shadow banking sector in China. Although shadow banking sector in China is entirely different from shadow banking sector in US. There's an entirely different thing. So we are talking about off-balance sheet activities in China. Basically, those lending activities through trust companies, leasing companies. On the savings side, we see just growing wealth management products. I totally agree. This is kind of I view this as experiments towards marketization of interest rates. This going to provide the incentives for these state-owned banks to reallocate their assets. But I can see, once again, just go back to the political economic consideration to think about how, these big state-owned enterprises view the whole process. I think the recent huge amount of policy uncertainty probably related to to how to understand the view of the central bankers in China and these major commercial banks view this shadow banking sector. On the one hand, I think there's some evidence suggests that the policymakers in China are kind of in favor of going this direction, because the premier has been talking about kind of adjusting the stock. We don't exactly know, what he means, but it seems that he's pretty much unhappy about the current way of allocating capital. So probably there will be supports for this future growth of shadow banking sector in China. But on the other hand, you clearly see the government has been quite worried about how this shadow banking system has been channeling money. A very unhappy thing that they clearly do not want to see is, if you look at the data, you will find that much of the money has been channeling through to these real estate developers, to those infrastructure projects made by local governments. So these are probably not entirely consistent with the view that our premier has in his mind about adjusting the stock. So that's why probably in the future I was expecting they're going to impose some further restrictions on this shadow banking sector. But the bottom line is, clearly, you can see a tension here. There's some supports for us to go ahead, and there's some concerns, to try to regulate this fast-growing shadow banking sector.
Great, thank you. Let's stop here. We'll take a break for 15 minutes and plan on coming back here maybe about 5:35.